Hey, folks, welcome to InTheMoneyStocks.com's live trading action video. My name is Gareth Soloway. Today's date is Wednesday, January 28th, 2015. Now, good video for today is to talk about the dollar, the strength in the dollar, especially because today the FOMC policy statement will be made at 2 p.m. Now, the dollar, this is the chart here in front of you, the UUP, which is the ETF that tracks the dollar. So again, look at this move on the dollar. If I zoom out again, and we've already zoomed out a little bit, I mean, you're talking about a low pivot back less than a year ago of 21. We're now at 25. So that's essentially a 20% increase in the value of the dollar, especially in relation to relative currencies such as the euro and the yen. Now, that is monstrous, folks. Absolutely monstrous. And the Fed hates this. Absolutely hates this. Now, as an individual investor, I actually like it. Why do I like it? Well, gasoline prices have dropped dramatically. We've seen a lot of commodities come down, so it's cheaper for us to build houses. It's cheaper for us to fill up our gas tanks. It's even could be a little cheaper to make some food and get some food at the grocery store. So for the average investor, it's good, but the Fed hates it. Why? Well, first of all, this is keeping inflation down and even possibly bringing on deflation. And the Fed is so scared of deflation. Why is the Fed scared of deflation when it's so nice for us as consumers? Well, because the Fed has this weird outlook that says if people think that prices will be declining, which is what deflation is, right? It means that, prices right now are actually going to go lower in a year from now. So the Fed says to themselves, well, if the average consumer thinks that the price of a car is going to drop next year, they're not going to buy the car this year. They're going to just wait. And the idea is if deflation continues, they just keep waiting and waiting. I don't necessarily believe that because I think people like to spend money ultimately and like to buy things, and when they need something, they're going to get it regardless. But that's the Fed's view. And listen, if that's the view, that's the way they're going to be handling the situation. In addition, the dollar increasing by this much, the Fed hates it as well because, again, it's hurting multinational companies and it's going to hurt the stock market in that way. So the Fed, again, and my thesis of this video is the Fed is not raising interest rates in 2015. I'm telling you right now, I don't care what they say in the statement today. I don't care what they say the next time. I am telling you right now, you will not see interest rates go up in 2015. And again, the bottom line is, they do not, if they raise interest rates, this dollar goes stronger. If the dollar goes stronger, commodities go lower, deflation is a bigger scourge out there. They're going to worry about that more. And in addition, the stock market's going to start to come in because, again, simply put, look at Procter & Gamble earnings. All right, look at Microsoft earnings. Here's Procter & Gamble. Look at the hit it took over the last couple of days. Microsoft, all right, take a look at that fall. All right, these are all places or companies that sell overseas. And when you sell overseas, you're selling your Microsoft product or your Procter & Gamble product for euros, for yen. And then to bring it back to convert it, you have to convert it back into dollars. Well, if the dollar has now increased by XYZ amount against those currencies, you're taking a loss. That means these earnings get hurt. And Caterpillar was a great example of that as well. Took a major hit and has taken a major hit, but these multinationals are going to get hurt. And these are big components of the Dow Jones Industrial Average, folks. I mean, look at the Dow Jones. It's made up of the Home Depots. It's made up of the Exxons, the Disneys, all these different players out there that do have exposure overseas. And again, multiple reasons why the Fed wants the dollar weaker, but this is what the problem is, and this is the last thing I'm going to say, folks, is that every central bank, Japan, China, Europe, they all want their currency cheaper. They all want to devalue their currency. So now the Fed's in a conundrum because the Fed is now understanding this even more so is that, okay, the Fed wants a cheaper dollar. They want the dollar to go down versus the euro and the yen. However, those central banks want their currencies to go down versus the dollar and versus other currencies. So now you have a major, what we call a currency war. And ultimately, folks, I'm telling you right now, it may be years from now, but this will not end well. This is going to ultimately blow up in everyone's face, and ultimately it'll be a disaster when it all hits. I still think we have years to go before that happens, but it is something that a smart investor wants to be aware of. You don't want to act on it right now, but you want to just be aware of, so 3-5 years from now, you will be ready to react. All right, so again, guys, crazy stuff, and we'll hear from the Fed today, but again, look at this chart of the dollar. Amazing move on the dollar, and again, you can look at the FXE, which is the Euro ETF. It's a good one to look at. Look at the collapse on this, and again, again, their currency is becoming cheaper, which means their goods are cheaper for us, which is good for their economy as well. But again, it's not good for the U.S. necessarily. And that's the problem. And the Fed is, again, facing an issue here where they're kind of boxed in. Because if they devalue the dollar, all these other central banks are going to devalue their again and again their currencies. And it's just going to kind of be tit for tat. And ultimately, very, very dangerous scenario long term on this market. All right, guys, enough said. Come join us at InTheMoneyStocks.com. Hopefully, you feel educated from watching this video and understand the conundrum and why the Federal Reserve will not raise interest rates at all in 2015. And honestly, they may not even raise them for the next couple years. Depending on how things go, very possible we don't see interest rates go up, actually go down more likely. All right, guys, take care. Come join us here at InTheMoneyStocks.com.